so while we're on the subject of time frames, I want to touch very quickly on being able to use or utilize multiple time frames, because this is a skill that is really going to just change your trading for the better. We mentioned that if you were scalping, if you're trading very short term, you're going to use a short term time frame. Let's say like a 5-minute chart, for example. That's all very well. However, you need to be aware of the price position relative to another chart. So what you want to try and do is to show as many different time frames within reason. There's no point in going crazy here, of the market you're trading. So say we're trading the FTSE now. We might want to visualize, and this could be on multiple screens, this could be on one screen, whatever it may be. But here, we've got 4 charts. We've got a 1-minute chart for our execution. We've got a 5-minute chart so we can kind of see what happened yesterday and how we are relative to yesterday. And I've got this a bit squashed up, so it's not displaying as well as it would be on your screen. We've got a 15-minute here, but you know what? I might go to an hourly because that's giving me the same kind of view as the 5-minute there. So I can see, oh, okay, interesting. Several days ago we had this sort of dive lower, pull back up. We haven't really clawed back up there. That's interesting. I can look at the daily chart here as well and see there's a big gap there, and see that we're just kind of oscillating where that gap was, and where are we relative to the beginning of the year. We're still very much in a range, in the middle of the year range, which is important, but it's not going to influence my day-to-day decision. But perhaps if we started to push down and we were here, for example, then that's going to influence my decision, because if on a daily chart we're here, on a 1-minute I can't see that, but I need to keep it in perspective of where we are, because perhaps there's a little bit weaker than I thought, and maybe I'm looking for shorts as opposed to going long. So it's important to not overdo the information. You don't want to have a 1, a 3, a 5, a 15, a 60, a 120, all those. You don't have everything. You just need a handful of charts that give you enough picture. Now, a lot of people are going to say, hey, you definitely have to use a 15-minute, or you definitely have to use a whatever it may be. My answer to that is you do not have to use anything. And I will always change the chart time frame to bring in the information that I need. That's as simple as that. If that has to be a 60-minute, it has to be a 60-minute. If it has to be 120-minute, it has to be 120-minute. Let's look at an example. If I go to a 15-minute time frame now, okay, and my chart is only giving me 5 days worth of data, that's really good. But I know that if I go out a little bit broader, I'm going to see this, which is a really interesting piece of the market puzzle. I think you will agree, because there's something obviously has come out here. We've recovered. This is a key part of the last month's trade. It was a very significant part of the month. It left a big dent on the chart, and so I want to have that in my vision. I want to be able to see where we are. So tomorrow maybe we're down here, maybe we're up here. I want to see how we are in reference to something that was important. If I went to a 15, for example, and let's knock it onto a 15, unless I zoom right out and lose some of the clarity intraday, I'm not going to see that, especially if I zoom right out and look for the portion of the down move. I'm going to lose the clarity, the granular clarity of each individual chart and each individual candle, and it sort of defeats the object. So you need to go back as far as you need to go back. It kind of seems it's a bit of almost a silly saying if you like to look at it like that, but you want to look, and that comes into play as when we're looking at highs and lows. Now this is a 2-hour chart, but I might want to keep this low in mind, because let's say we are trading at that low. I want to keep that in my vision, but I'm losing the granularity of each candle, so I'm going to go to a 4-hour. I'm going to zoom in a little bit better. I'm going to say, okay, there we go. Now obviously I'm going to remove my vertical lines for this because it's a little bit crowded, you can see that. But let's say we're in that example now, and we're sort of trading around here. I can still see where that key low is. It now comes into play because we're nearly there. If we weren't there, I wouldn't need to go back so far. So you're only using the time frame to fit things in that you need to fit in. If you've been in an uptrend, let's say for example we are here, and we're trading an uptrend, you don't need to go back so far, because you know that it's kind of 300 or 400 points away until you get back to a decent level. We're in an uptrend, so you can quite happily dial yourself down to the 15-minute, give yourself that little bit more clarity on each candle, on each bar, however you've got it. Let's find it, so if you can see it again, where we were zooming right out back to about here. So here you go. So 15 minute is absolutely fine for this. We do not need to see what happened 3 weeks ago, because 3 weeks ago the market was miles away. So it doesn't make any sense for us to look at that on a daily perspective. We can zoom in, have a nice 15-minute chart, give ourselves 3 or 4 days of much more detailed information. So it's a very variable process. How the market has been trading, where the position of the market is relative to the prior week, the prior few days, the prior year, whatever it is, or relative to key ultimate levels in our time frame, and then just picking the chart that matches it. You don't need to be wedded to a 5 or a 15 or a 60. You can tweak it. Very often, just moving on very, very quickly here, very often I'll use a 3-minute chart when I'm trading intraday, purely because I know, let's go back to today, I know that a 3-minute is giving me a good granular grasp of what's going on. It's not too noisy like a 1-minute chart sometimes can be. Too much noise, and you get a lot of chop, and you get a lot of useless information. Your screen ends up being filled with kind of many candles that are just the same and not giving me too much information. So a 3 gives me that kind of useful information where I'm trading. I can see all the day's trade. I can see the previous afternoon's trade. If we then start to go into new levels that kind of are the same levels that we were in the prior morning, then I'll switch to a 5. But a 3 is not a bad medium. So again, find your perfect time frame. Don't forget to look at the higher time frames. Don't neglect those, even if you're short-term trading. And the same vice versa, even if you're swing trading, don't neglect your lower time frames, just to see where we are relative to maybe the morning, the afternoon, or the prior day.